Hello and welcome to Portfolio Matters Week 63 weekly update. And again, a very busy week with the UK budget and oil prices spiking again. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So Keith, what have we got this week?
So I'm afraid it's another packed week on the Portfolio Matters podcast. This week, the Fed announced that it was going to aggressively move to tighten interest rates, and that has caused a spike in bond yields. Oil prices moved sharply higher, partly on the back of Russia announcing that there was storm damage to the CPC pipeline that runs to the Black Sea, and it is closing that down for 2 months, and that may take around 1 million barrels a day out of an already very tight oil market. Do we believe them, or are they just playing geopolitics? And finally, it was the UK budget. Richard.
Thank you, Keith. So Rishi Sunak stood up and said he was a tax-cutting chancellor, which he isn't. He has tried. He's trying to square a circle, which is basically everyone is complaining about higher costs of living and higher taxes, but we have this problem with having spent vast sums of money on COVID, and basically a government can't fund consumers for the cost of inflation because it is a self-referential process. So he announced a temporary cut in fuel duty by 5p a litre for 1 year, which will make a small difference. A rise in the NI threshold, which is designed basically to cushion the impact of higher costs of living on lower paid workers. And I think actually will have a fairly real impact there, which is a good thing. 1% reduction in the lower rate of income tax to 19%. But of course, that starts just before the general election, strangely enough. And again, it's designed to affect the lower paid part of the population. And the cap on domestic energy bills is expected to rise again. And clearly there's very little government can do about this because we are in the global energy market and we have to pay what the global energy prices are. So the UK tax burden, highest since just after the Second World War, and fundamentally the cause of this is generalized high government expenditure, but COVID has wrought havoc with government finances. And UK living standards are, which is the forecast of the blue line, current forecast as opposed to the earlier forecast, which basically before Russia invaded Ukraine. UK living standards are expected to suffer a significant decline over the next few years. Interestingly, however, we're going to catch up, and I doubt that very much, frankly. And you have this big fall in real disposable income, which obviously is the same thing effectively as a decline in living standards. And so the biggest hit to real earnings in 6 decades. Yeah. And it's remarkable, isn't it? A year ago, there was no inflation. Anyone who talked about inflation was an idiot. And now we have massive problems caused by inflation, some of which have obviously been exacerbated by Russia invading Ukraine, which is a bit of a wild card. But fundamentally, there was a problem which this has now exacerbated. So this is really unfortunate. So economic growth was stronger than forecast, but the forecasts have been, next year's economic growth forecast has been cut.
Over the last few weeks, I have talked quite a lot about how I think there's a recession coming. And actually, in a minute, we're going to go through a UK household budget, and which I think will help justify my thoughts. But I think these numbers are going to be revised down hard. I just can't see any way we can have continued economic growth given the massive knock to consumer expenditure caused by rising energy prices and rising taxes, actually. Because one of the things that the Chancellor has done is that we now have RPI inflation of 8%, but he hasn't changed any of the tax thresholds. So he's got this enormous boon as real tax levels, the point at which you start paying taxes has fallen in real terms. So that's why his revenues are so strong. Yeah.
And earnings are going up, not at the rate of inflation, but earnings are going up, pushing people through the tax thresholds. And as Keith says, then the tax take by the government increases. So how is he giving back the money that he's recently raised? So, well, this is a graph really you just need to sit, a chart you need to sit and have a look at. But his total raise is on the right hand side, and the various handouts or reductions in tax are shown in blue, and then how he's tightened tax is shown in red. And his main tightening is obviously the income tax and the national insurance, which are two of the biggest tax takes in the Treasury. So have a look at that one. Because interest rates haven't really moved, but the tax take has increased very significantly. The higher debt servicing costs in the gilt market are more than outweighed by the tax take. And of course, the gilt market doesn't reflect, as far as government funding costs are concerned, the gilt market doesn't reflect instant interest rates. It reflects the interest rate at the date at which the gilt was issued. So there's a 30-year gilt, at 5%, then it pays 5% throughout the life of its gilt, as we know. So funding costs will move as the existing portfolio of gilts issued expire and new gilts are issued to roll that debt over. So it will be a slow process of increasing funding costs.
Thank you, Richard. Okay, on to this week's economic data. And there wasn't that much of it, but the data there was quite interesting. Okay, so US home sales missed expectations. And we're going to do a section on US housing in a minute. But the most important news was that we had global PMIs, and they all were strong, amazingly strong, given that these are numbers for March, so post the Ukrainian invasion, and they all beat expectations and were either up or pretty much unchanged from February. So the US expectations were 55.4. The number came in at 58.5, so substantially higher and up on February. So that's really reassuring for the US economy. UK expected at 57.8, came in at 59.7, so a decent beat. And that was pretty much unchanged from February. EU, it was expected at 53.7, it came in at 54.5. Slightly down on February, but really very resilient in the face of the huge disruptions caused by the Russian invasion of Ukraine. And the final number I want to talk about is UK inflation, which came in hot yet again. Expectations were for 6.1, it came in at 6.2. Now, government is forecasting that it could go above 8, and market commentators are forecasting above 10. So inflation is expected to keep on rising. Going through some charts. Richard.
Thank you, Keith. So 2-year bond yields are continuing their steep rise in the US, and that is clearly a reflection, at least in part, of the Federal Reserve's comment that it's going to continue raising interest rates, 8 quarter-point interest rates over the next year or so. Whether you believe that or not is a different matter. Clearly, the bond market is reacting to that, which of course is partly what the Fed wants. So it is talking up interest rates quite successfully at the moment.
Yes, I don't think the US can raise rates as much as the bond market seems to think it can. Because if you think we're having an enormous energy shock, although to be fair, the US is not suffering the same high gas prices that Europe is, but it's certainly suffering from high petrol and oil costs. But this is just adding to the headwinds facing the economy. And at some stage, I think the economy slows down and they don't get to 2%.
Without wishing to preempt any discussion we may have in a few minutes, but I mean, I think globally it's likely that there will be something like a 3 to 4 million barrels per day deficit in oil supply, given the amount of oil that is disappearing from the supply from Russia, taking into account the fact that Iran will probably come back and so forth. And that means that the economies have to adjust to consuming 3 or 4 million barrels of oil a day less than they currently are. And that means that economic activity has to reduce. However, the US is self-sufficient in oil. And if the US decides to be vigorously and aggressively self-sufficient and ban oil exports, it can control its own oil prices effectively. Its economy will not have to suffer the slowdown enforced by that supply deficit. And all the other economies in the world will take the hit of the US as well as their own share of the hit. So the US may and is able to insulate itself from the economic damages it's causing, to the detriment of Europe and China, and obviously the UK. And that would be quite a nasty outcome, because the slowdown has to come somewhere. So as we discussed just a moment ago, Powell has convinced the market he means it and that he can raise interest rates. And there we are. As Keith says, one suspects that they won't be able to do so. They won't wish to do so for various reasons, but that is the plan. And Goldman are lowering their 2022 GDP growth forecasts. Not forecasting recession. I think, it depends. There could be a US recession, but if they become very aggressive on their oil production, they may avert a recession. They may not. I think the whole thing is so incredibly complex. We think we know why that bounce happened, don't we? We think that Putin used some of his ill-gotten gains to buy shares.
Yes, but he also banned short selling and he stopped foreigners from selling. Yeah, so
I didn't know he'd banned short selling. I did notice that some hedge funds are starting to buy distressed Ukrainian and Russian debt. I think they're very brave, but if they've got a 10-year time horizon, they may make a deal of money out of it.
Yeah, so I also think money isn't everything in life, Richard. And
principles count.
Principles count. Just don't buy Russian stuff. They're not nice people. You don't want to be dealing with them.
I couldn't agree with you more, Keith. So the US composite PMI, US initial jobless claims,
painting the picture of a strong US economy.
Yeah. And likewise, continuing jobless claims, same picture. UK CPI inflation, painting a picture of an economy in trouble. And likewise. If you want to protect yourself from inflation, you have to get in sort of before it happens rather than when it's happening. And my only proviso there is, if inflation doesn't come under control, and I think there's a significant probability that it doesn't come under control, it's still not too late to protect yourself from it. The EU PMIs and inflation watch. Keith.
Okay, so the only new numbers we had this week were from the UK, where inflation ticked up yet again to 6.2% CPI, 8.2% RPI. The war in Ukraine continues to have unexpected side effects, and I was not aware that actually a decent proportion of containers shipped from China to Europe come through Russia via the railway system, and they ain't anymore. So that is going to add pressure to an already congested maritime trade route. expect more supply chain disruption, particularly as the Chinese are locking down a few cities.
So obviously we don't give investment recommendations, but that does make you wonder whether investing in container shipping might be worth having a look at.
Yeah, the thing is, Richard, I think that we should have done that 2 years ago or a year ago. I think the prices have already moved a lot.
Yeah.
And KPMG are forecasting that UK CPI will peak above 10% later this year.
It's classic, those graphs all the same, aren't they? They still come off at 45 degrees from the 90 degrees from the uptrend. They can't do anything other than come off at 90 degrees with a clear spike.
Yes, very good point, Richard.
Like, they just make them up, don't they?
And European steel prices are spiking. Russia is an exporter of steel. So everywhere you're seeing inflation. This is a key input to loads of stuff. And 4 out of 10 Dutch greenhouse farmers have quit due to high gas prices. They can't afford to heat the greenhouses. So hence you're going to see tulips getting more expensive, etc., etc. We noticed that, so this week, Rishi Sunak cut UK fuel duties by 5p for 1 year. But in Europe, petrol taxes are a key source of revenue. And in Germany, this is the revenues from fuel, and governments are getting a boon as fuel prices rise, so their tax take also rises.
I'd just like to point out, Keith, as far as I'm aware, Rishi Sunak didn't cut the 5% tax on gas and electricity on household bills, did he?
No. I thought this was an amazing chart. So this is US domestic auto inventories. So there aren't many cars in the showroom. This is actually a really good chart for economic activity because the car manufacturers are going to have to get going.
I mean, you'd say, wouldn't you, that the US car inventories need to go up by 1.2 million in order to get back to where they've sort of been on average over the last decade or so. But the input prices for manufacturing these vehicles have gone up extraordinarily. And the prices of vehicles that come back into the showrooms will probably be 50% higher, which means they won't sell so many. So if they restock at those high prices, and that is the recessionary implication of this massive inflation we've got. Well, when I said that the US can insulate itself from oil prices, it can't insulate itself from any other commodity price, possibly grain actually, but not from any of the other commodity price increases.
So this chart is of used car prices in the US, and it shows that the blue bars are monthly and on the left-hand axis, and shows that in the last couple of months, prices have come down, although annual inflation is still running at about 20%.
And it does illustrate, it's got two basically discontinuities in that line, hasn't it, Keith? One in April 21 and one in August 21. So there's no reason why it shouldn't have more discontinuities in the shape of the line, of the month on month. Sorry, the year on year line.
But it does show that there's a limit to everything. I mean, people have just been put off by extremely high prices.
Yeah, that's true.
And home rental prices continue to rise. And as we've covered many times on the weekly, that will feed through to CPI with a lag. Now, we have talked several times in previous weeklies about the analogy with the 1970s, when there was an enormous spike in oil prices and inflation. And what this chart shows is that actually corporate profitability held up apart from during the recessions. So that's quite reassuring. Companies managed to adapt to remain strongly profitable during periods of high inflation. Bond market inflation expectations are continuing to rise, suggesting the Fed remains behind the curve. This is German PPI, came in at 24.9%. And returning to the 1970s, This shows the performance of US equities over the period in real terms. And so what it shows is if you manage to avoid the recessions, and that's crucial, actually equities kind of held their value in real terms. They weren't great, but they weren't a disaster. But getting out before the recessions was absolutely crucial. Okay, on to Invasion Watch. So this is last week's map. This is this week's map. Can you spot a difference? Not really. Actually, the Ukrainians have retaken this tiny bit around Kiev, but the invasion is not making fast progress. It's grinding on. There's not much evidence that the tide is turning back yet, but there's not much evidence of progress either. So frankly, on this week, it seems like this war could last for a very long time. This is a close-up of Kiev, and the blue area Ukrainians claim to have recaptured. Okay, so on the internet is a wonderful thing, and there are various websites essentially which document equipment losses from both sides, and they only count equipment losses that have been verified by photographs. So both sides are claiming to have inflicted much higher equipment losses than are documented on this website, but the evidence they've got shows the Russians are losing a lot of stuff. This is total equipment losses. This is abandoned equipment. So in the early days, the Russians were abandoning a lot of equipment as they ran out of petrol, but that seems to have slowed. Captured equipment, the Ukrainians continue to capture equipment at a pace and now have more tanks than when they started the war. Net equipment changes. Ukrainians have added stuff they've taken off the Russians. The Russians have lost a lot of gear. These are tank losses. The Russians are steadily losing tanks.
And the interesting thing there is that the Ukrainian army is basically equipped with Russian equipment, so that they can operate all the Russian equipment because they are used to it. It's what they have in their own military. Yeah. And it's also interesting, isn't it, that the US is trying to coordinate the delivery of S-300 missile systems that it has, which is Russian-made anti-aircraft missile systems, which it has, by nefarious means one suspects, accumulated over the years. It's trying to deliver them to the Ukrainians because the Ukrainians can operate an S-300 missile system.
Interesting. Armored fighting vehicles just steadily losing equipment every day. Infantry fighting vehicles, aircraft, actually continuing to lose aircraft.
And that's one of the problems the Russians have. They haven't ever managed to get in place air superiority, which means that they can't support their infantry and their armor against Ukrainian infantry.
And I noticed the British are supplying an advanced anti-aircraft missile system.
Yes.
And this is interesting. This is surveys of the Ukrainian population asking how confident they are that they can repel the Russian invasion. Answer, increasingly confident. So as the war goes on, the morale of the Ukrainians is improving, and you strongly suspect the morale of the Russians is declining. So what's Putin going to do? What is his end game? It doesn't seem like he can win unless he's willing to commit vastly more forces. So in summary, the war looks like it's grinding itself into a stalemate that could last for a very long time and be expensive and move into an attrition stage where Russia essentially just seeks to destroy a lot of Ukrainian stuff. From an economic perspective, that means sanctions on Russia will last for a long time and expect continuing disruption to the world economy. Okay, Now, some original research from Portfolio Matters, the UK household budget. Now, in previous weeks, I have talked about how high energy prices will cause a recession. And regular viewers will know I've sold pretty much all the stocks I own apart from energy companies, because I expect high energy prices to reduce consumer spending on anything else, essentially. So this is from the Office of National Statistics, and this is a breakdown of how the average UK household spends its money. Average expenditure is £585 a week. Okay, so I have used those figures to work out how rising energy bills are going to impact household discretionary expenditure. Now, reminder, UK energy bills are rising by 54% on the 1st of April, i.e. next week. And then in October, they're expected to rise a further 42% to £2,800. So in the course of 6 months, they will more than double. So how will that change the consumption basket? So I've split the OS&S figures into non-discretionary expenditure and discretionary expenditure. So if you're interested, pause the video and take a look. So the energy portion of the bill is here, about £21 a week is spent on energy. Now, I'm just going to model the effect of rising energy bills on that line. So household energy expenditure. Rising oil prices will affect other lines in the non-discretionary expenditure, particularly transport. But I'm not going to model that. We're just going to look at changes in energy bills. So I calculate non-discretionary expenditure around £360 a week, discretionary about £230. We could argue about individual lines, but I think alcohol and tobacco is absolutely non-discretionary for a civilized person. So after the 1st of April, energy expenditure rises to £32 a week. So non-discretionary expenditure will have risen by £11.30, which means, everything being equal, discretionary expenditure will have to fall by £11.30, i.e. down 5%. On the 1st of October, it gets worse. So the change will have been up £33 a week just on domestic energy bills, which means that discretionary expenditure will have to fall by 15%. So people will be going out less, they'll be going to restaurants, cinemas, etc., less than they were, down 15%. And to me, that means the whole service sector is likely to suffer quite a steep recession. 15% drop in expenditure, that's a recession. So just modeling the impact of very steep rises in domestic energy bills, you can see that UK consumers are going to have to cut back quite hard on their discretionary expenditure because they're going to be spending that money on higher energy bills. And I think that will cause a recession.
Yeah, I mean, you can say, can't you, effectively, that of that roughly £600 that you started with of discretionary plus non-discretionary, £30 disappears in energy, and therefore you've got a 5% drop in total consumption, other than non-energy consumption. And absent any pay increases, that is a 5% drop overall in demand across the whole economy. And however you cut it and whatever sort of ifs and buts you put in there, that is a very big problem for any country that can't control its energy prices. Moving on to the US housing market. So the Case-Shiller National Home Price Index continues to increase dramatically, rapidly. And you could argue, couldn't you, that it's sort of reached an exponential growth point in 2020. And if you look at the equivalent exponential growth point in around about 2004, that ended with a very steep decline in house prices over the next 4 to 6 years. So with interest rates going up, I think it's a fair bet that US house prices are going to come down sharply. So here we see that the median house prices seem to have peaked, a little bit of a tick down. And although there's been a very rapid increase in house prices, the question is that sustainable? US existing home sales are, there's a lot of noise in that chart, but they have the very rapid increase post-COVID has clearly come to an end. And the question is, are they now dropping? Is there now a change in direction of the trend? And are US existing home sales beginning to fall? And you see the same thing with US new home sales. And are they going to start to fall?
Yes, we know from previous weeklies that US consumer purchase intentions are falling. People are being put off by very high prices.
Yeah. So new home construction starts at a record. Obviously, there was a booming market from the beginning of mid 2020, and house builders have seen that and have grabbed it with both hands. And there is a question now, I believe, of whether there is going to be a glut in the market. US mortgage rates are starting to climb. They are still very, very low historically, but any increase in the mortgage rate is going to put pressure on house purchases. And if they continue to rise, that pressure will only increase. And it's not just the absolute rise, it's the percentage increase. So they've gone up from, if we look at 2021, from around about 3% to 4%. Well, that's a 30% increase in your mortgage cost. And obviously, we have this increasing expectation in federal funds rates, which suggests that there should be an increasing, continuing increase in the mortgage rate. And as we also know, real rates are still very low. In fact, they're getting more low because the inflation rate is picking up and rates are only going up very marginally. It's interesting, actually, real rates are below where they were in the mid 1970s. And so we can see here that the value of the mortgage that people can afford has gone from 3% a year ago, which is around 200,000, to around about 170,000 now. And that is likely to continue to drop, meaning that people can't spend so much money buying a property. This is a little analysis that Keith has put together that shows the maximum theatre house price has fallen by about 15% since January 2021, which is really interesting. It also raises the prospect of whether people who have bought recently will actually find themselves in a year or two's time in significant negative equity. So our conclusions are that the rise in US house prices is unsustainable given the rise in mortgage rates. US house builders will be squeezed by falling house prices, rising input costs, and lower demand. And the construction market is very important to the US economy. And when it turns, the rest of the economy may follow. And I would say that basically you can extrapolate these conclusions to the European property market, the UK property market, and we know what's happening in the Chinese property market. So, and all of the economies, to a greater or lesser extent, are very much dependent on housing activity. And so more rising interest rates can have a very severe effect on economies simply through the effect on housing, never mind everything, all other activity.
Yeah, if we think back to the previous section about the UK household budget, rising interest rates, if they will also increase the expenditure on the non-discretionary basket, which means you're going to have to cut down even further on the discretionary basket.
That's a very good point, Keith.
Okay, a section on the 1973 oil shock. So what was its effect on the stock market? Well, actually, it wasn't instantaneous. So this is monthly data. The shock was on 19th of October, 1973. Essentially, Nixon requested emergency military aid for Israel, and OPEC responded by an oil embargo on the West, causing a big jump in the oil price. But we look at more granular data, you'll see that there was an initial sell-off, but then actually the stock market went sideways for 6 months. And it didn't really sell off until, what's that, June 1974? So 8 months after the initial shock. But then when it did sell off, it sold off hard. So you're then talking about a fall from like 95 to 62. So it lost a third very quickly. So the bottom line is that the market does not discount these things instantaneously. But when the market starts to turn down, get out. Sell in May and go away may be a sensible decision this year.
The only proviso there is, will the central banks step in to support markets, which they didn't do in the 1970s.
That's true. But then, just like in the 1970s, Richard, they're now raising rates. Okay, now, yield curve inversion is traditionally a predictor of future recessions. And what's interesting this time is that the two yield curves which people normally look at, that's the 10-year minus 2-year and the 10-year minus 3 months, are moving in entirely opposite directions. So normally they move together. This time, the 10-year minus 3 months is not signaling anything like a recession. Well, the 10-year minus the 2-year is approaching the point where it would signal a recession.
Is that suggesting that we're going to have a recession, but just not yet?
I don't know. I come back to your point, which you have raised many times, Richard, about how the bond market is now so heavily manipulated that is it a useful signal at all? So based on the 10-year minus 2-year, we have a rising probability of recession. But on the 10-year minus 3 months, we've got no possibility of probability of recession at all.
That's extraordinary, Keith, because actually, if you look at that chart, the visual correlation is substantial. You know, they are closely correlated, and suddenly, for the first time, they are not correlated. If you look at 1996, say, the black line lags the blue line, and it's just possible that we may have a lag of a couple of months, and then a confirmational move in the 10 minus 3 months.
Yeah, but in summary, the bond market currently disagrees with Portfolio Matters in that it is not really forecasting recession.
Well, it'll catch up with us, Keith.
Yes, well, exactly. So this table shows the performance of the S&P 500 in the period before and after a yield curve inversion. And the bottom line is actually not disastrous. You look at 12 months later, the S&P 500 is generally up 8.2%. So,
I mean, you might say, what's all the fuss about, mightn't you, in terms of stock market investment?
Yeah, absolutely. So going through, this is the 10-year minus 3 months versus the S&P 500.
But not, Keith, if it's caused by an oil shock.
Precisely. But the thing is, the bond market should discount that. The bond market should be, is by reputation much smarter than the equity market and will be, processing all these variables. And anyway, the last time there was an inversion of the 10-year minus 3 months, it was, about a year early, essentially the first time it did it. but obviously the recession was finally caused by COVID, so it's just got Nostradamus-like powers and they predicted COVID. If we look at the Dow Jones, well, you would again, the equity market continued climbing for a year, and if we look at the 10-year minus 2-year, then it only actually inverted briefly once. And full disclosure, I got out of the equity market somewhere about this point, actually, when there was a yield conversion. And so that was very good news. I missed out on the subsequent climb, but then I had cash to buy them at the bottom. In summary, the bond market is not really forecasting recession. I think they're wrong. But, the bond market is meant to be much smarter than yours truly. And even when the bond market signals a future recession by having a yield curve inversion, then it tends to be early. It tends to be about a year to 18 months early. So in summary, the bond market is not predicting a recession in the next 2 years.
Well, I think we have to look at the facts and draw our own conclusions, our own reasonable conclusions, don't we, Keith?
Yeah. And I would also say that as a private investor, your number one priority is not losing money.
Yeah.
So, where are the risks, upside or downside? And to me, there are big risks on the downside. I prefer not to hold, anything apart from oil and gas stocks, frankly.
Yeah.
Okay, other charts, Richard.
Thank you, Keith. Okay, so the world economy, as we have discussed on, in previous editions and also significant today, is receiving a huge shock from rising oil prices and now rising interest rates, and incidentally, a rising US dollar. So this chart just shows the ISM manufacturing PMI as a dotted line against the combination of dollar, oil price, and interest rates. So that's the financial condition, if you like. And it shows that the ISM follows the financial condition reasonably closely. Financial conditions plummeted from 60 to 42. Therefore, we would expect the ISM manufacturing PMI to do the same, which basically would make it drop below zero, which would sort of push us into a recessionary environment.
Yeah, that is my expectation.
Yeah. So Germany's industrial expectations for industrial growth taken a huge hit, which is totally contrary to the PMI figure, and you just wonder what's going on there. We talked about it last week. It seemed to be inconsistent, and we seem to have still got that inconsistency. So, of course, it took a huge hit with the rising energy prices, the biggest since the survey began nearly 40 years ago.
Yeah, this is actually approaching minus 100%. So almost everyone surveyed thought conditions were going to get worse.
Yeah, and when everyone is that gloomy, it's not likely. Well, it might bounce back up if Russia withdraws from Ukraine and says, we're terribly sorry, and here's $200 billion to rebuild. But that's unlikely. So the IEA, International Energy Agency, plan to cut oil use during the current energy crisis. Well, this plan is, use your bicycle, drive more slowly, share cars, use lightweight trucks, obviously go by train where you can, avoid business travel, and move to electric vehicles. I actually don't understand how moving to electric vehicles does that, but there we are. That's one of the fallacies of ESG people. So if we did all of that, apparently we'd reduce oil demand by 2.7 million barrels a day, and we'd be tickety-boo. Global container rates slowly coming back down, but one suspects, given Keith's observation about the shipping of hundreds of thousands of containers across Russia, or a million containers across Russia every year by train, that container rates are not going to come back down anymore.
Good point.
Interestingly, so I'm actually on the Solent at the moment, and yesterday I saw two huge container ships going into Southampton. Enormous container ships. absolutely full to the they stack them up on their decks. So clearly a lot of containers yesterday came into Southampton. So those items from China you're waiting for will be arriving shortly. JP Morgan models are forecasting rising risks of recession. Well, it's.
But you notice they say within 3 years, Richard. There's very little chance of recession within 1 year. I'm amazed.
Yes. Corporate bond spreads rising rapidly. We discussed this last week, and the trend is continuing. So basically, this means that people are viewing corporate debt as more risky than they used to view it, which means they're viewing the economy as less strong than they used to view it.
Yeah. Financial conditions tightening.
We have discussed that the energy dependence of the world, and one of the energy dependencies of the world is the fact that effectively we eat oil, because oil goes, and gas, oil and fossil fuels go into the production of fertilizer. Fertilizer increases crop yields. Clearly, we are supported by crop yields. And this is a chart that shows how that has occurred since the population was about 1.8 billion in 1900 to the 7 billion now. More than 50% of that population increase has been supported by nitrogen fertilizers, and i.e. by fossil fuels. And this begs the question, what happens when the supply of energy available and the cost of energy available for fertilizer manufacture increases hugely? What it does is it impoverishes poor nations. So rice prices haven't gone up. Is there a theory as to why rice prices are quite stable, Keith?
I don't know. I mean, presumably because there hasn't yet been substitution from wheat into rice. But, when Egypt finds that it literally can't get hold of all the wheat that it requires, you would suspect it starts buying rice.
Yeah, okay, I'll do this. So equity markets this week. So the FTSE all shares up 1%, pretty much unchanged year to date, really, in the scheme of things. The stocks Europe down 7% year to date, and not very much change in the last week. The S&P 500 had a good week, but still down 5% on the year. And the Nasdaq had an exceptionally good week, still down 9% on the year. What you can see from that is things are very volatile. Markets are very volatile. Topics up 3.8% unchanged on the year. Bitcoin had a very good week, but still down 5% on the year. The pound stabilized, is basically oscillating around 131, 132, down a little bit on the year, and the dollar index substantially up on the year. A lot of that is against the euro, which has had taken a bit of a beating recently. So equities higher than they were before the invasion. Keith, do you have any comments on this?
Well, I think it's absolute madness. It's bull markets are amazingly hard to kill. It's astonishing. The disruption caused by the Russian invasion of Ukraine, I would say that you can see all the disruption coming down the pipeline, but most of it hasn't hit yet, and the market just doesn't want to think about it.
So despite what I've just said about markets being volatile, this chart says that as war has intensified, volatility has fallen, which feels counterintuitive to me.
Well, I'd say war in Ukraine is now turning into background noise. So as long as there's no escalation, so no nuclear weapons or chemical weapons are being used, then people are getting used to the situation, I'd say.
Yeah. And unprofitable tech has had a strong bounce. Goldman Sachs non-profitable tech index. I ask you, what does that say?
You only get strong bounces like this in a bear market. Now, my personal prejudice is this is trending towards zero.
Yeah, I think now is not the time to take the plunge on the ARK ETF.
Yeah. Although, have you seen ARK has continued to actually get inflows? Amazing.
Yes, and it's not doing too bad at the moment, but I think now is not the time to get into it. And stocks have massively outperformed bonds since, and the 60-40 portfolio is dead, isn't it?
Yeah. And actually, this is something we have covered relentlessly since we started the podcast, how you should not be owning any bonds.
Yeah.
And, there you go.
Yeah. The 60-40 portfolio only worked because we were in an environment of interest rates declining for 20 years.
Mm.
And it was just luck that it worked, basically.
Thank you, Richard. Okay, on to energy. And oil bounced back, up 7.8% on the week, up 50% since the start of the year in under 3 months. Natural gas also up 2.4% this week, up 60% since the start of the year. That's Dutch natural gas futures. Coal drifted off a bit, but up 92% in the last 3 months. Uranium climbed again, up 5% on the week, 35% year to date. Okay, figures that are relevant for the oil market. Well, crude inventories in the US fell by another 11 million barrels, i.e., supply is insufficient to meet demand, and that is before the disruption to Russian supplies really has impacted. So I expect that figure to get worse, and therefore oil prices are going to have to keep on rising until supply and demand are back in balance. Now, the US oil production, once again, did not change last week and is still down 200,000 barrels a day from the start of the year. So as yet, we are not seeing a supply response in the US. The Baker
Can I
Hughes...
can I just interrupt and say this US inventory figure is basically showing a drop of since the beginning of the year, about 1 million barrels a day.
Yes.
And consistently. So it is showing a consistent, steady million barrel a day drop.
Yep. And that's before the seasonality really kicks in, because we now enter the summer period where people tend to use more oil.
Yeah.
And finally, the Baker Hughes rig count fell by 3 this week. Mystified. So this is the oil price chart. So last week, if you remember, we had a huge sell-off as essentially everyone got margin calls and the speculators had to liquidate all their positions. Well, it's climbed back up this week. So this is OPEC's forecast for the coming year, and they are forecasting a record imbalance. And this chart goes back to 1960. They're forecasting 2.5 million barrels a day deficit. Now, Richard's point about the US having a 1 million barrel a day deficit, well, the rest of the world is also in deficit. So the rest of the world, you're talking about 2.5 million barrels a day. Essentially, oil prices are going to have to keep on rising until the market is in balance. We haven't yet got to demand destruction. And this is the pipeline through Russia, which the Russians have closed down. That pipeline mainly transports Kazakh oil, but about 10% of it is Russian oil. So oil exports from Kazakhstan are being impacted. But slight balancing from the reduction in Chinese demand due to COVID. They're closing cities. So that will be reducing oil demand, although frankly, we've seen that the US is in 1 million barrel a day deficit. And mystifyingly, world rig counts have actually been falling this year. I mean, what on earth is going on? They need to be...
Is one of the issues here that banks have decided under ESG pressure not to lend to oil companies, and therefore they can't get the cash that they need in order to put rigs in place?
Yeah, but Richard, they're throwing off so much cash they can certainly afford. The only thing you could say is perhaps there's a lag effect where they can, you have to book your rig months and months in advance.
Yeah.
And this is the US oil production by base year. And it just shows how preponderance of shale oil wells means that you have to just keep on drilling, because every year your oil production will fall by 41% unless you keep drilling. But anyway, last year, nobody did any drilling, basically. So oil and gas discoveries hit a new low, essentially. So this chart goes back to 2015. Last year, they only discovered 4.7 billion barrels of oil equivalent, which is pretty much half the previous low and a third of the level the previous year.
Of course, discovery doesn't equate to production, and we are consuming 100 billion times 365, 36 billion barrels of oil a year.
Yes, very good point, Richard. Now, this is the ECB's decomposition of changes to the oil price. And what's interesting is they're saying that actually almost the entire rise in the oil price is just due to supply. It's not due to speculation or risk.
Yeah.
And Saudi Aramco have this week announced plans to ramp production to 13 million barrels a day by 2027. So that's a rise of only 1 million barrels a day on their reported, i.e. purported, current maximum spare capacity. And that's not due to start until 2024. So the question is, A, do they have the spare capacity they claim? And, clearly they can't ramp up production quickly. And Goldman Sachs are forecasting Brent to hit 120 in Q2. Well, it's hit 120 in Q1. And this week, actually, we put out a short podcast by Stuart Owen on German energy policy. If you're interested, please have a listen. It's only about 6 minutes long. But adjusted for US disposable income, oil is very far from its 1970s peaks. So this may explain why most commentators are not expecting a recession in the coming year. Okay, moving on to natural gas. This is Dutch natural gas futures, which ticked up a bit this week. And, they're settled at 110. Bear in mind, back in April last year, they were around 20. So, up 5.5 times. And US LNG exports continue to rise. So that means that US natural gas prices should begin to normalize with the very high rates in the rest of the world, as essentially this arbitrages the difference in price between the two. And this is the forecast for natural gas demand to 2024, and it shows that most of the growth in demand will be coming from Asia. Actually, they weren't expecting much growth from Europe, but now presumably that European number is going to be rising, because Germany has announced that it is going to be replacing Russian natural gas with natural gas from the open market. And that means high natural gas prices, as essentially we have to outbid the Asians. And this is gas storage levels at the Gazprom owned Raymond storage facility in Germany. And essentially, Gazprom have run it down to zero.
Nationalization, methinks.
Yeah, but still, where are they going to get the gas from? If Gazprom aren't providing the gas, then, Gazprom, nationalizing it doesn't help.
New LNG terminals yet to be built.
Yeah. This is coal price, still very high. Uranium ticked back up. Looks like the bull market is back on. And reminder that despite the Germans closing down all their nuclear power stations, the rest of the world is actually increasing slowly its investment in nuclear power. And to be clear, on the Portfolio Matters podcast, we think that is an unalloyed good thing. Nuclear power has the highest energy return on investment of all power forms. So we need to invest in nuclear. Richard.
Okay, so the weekly industrial commodities, pretty quiet week, really. Nothing much moved. Aluminium did have a bit of a bounce. It's been very volatile. Neodymium has fallen a bit. Nickel didn't move very much on the week. Well, I think you have to draw a veil over the price of nickel given the shenanigans at the London Metal Exchange, which will doubtless have significant repercussions in due course. Ferrovanadium continuing to move up, nearly doubled on the year. And zinc had a big bounce this week. Not a particularly big year-to-date change in the context of commodities. So just running through the charts. Commodity booms do have a lifespan, but they don't end like that. So there is, you don't want to be in at the peak because it can drop very quickly. But I suspect we're nowhere near the peak of this particular commodity cycle.
Yeah.
So aluminium, cobalt, copper, continuing forecasts of growth in the copper deficit. So interesting that it's continuing to be forecast with the latest data available, which makes copper a good long-term investment, probably. Chromium, iron ore, lithium has now flattened. Magnesium, neodymium is falling back a bit.
Yes, all the green technology metals have had an amazing run, but it seems that finally they've hit a peak.
Yeah. Nickel, well, not much to say about nickel. Tin, it's fallen, dropped back a bit after almost a year-long run up. It's now falling back a bit. Ferrovanadium is still continuing to climb nicely. And there's zinc with this little spike this week. And precious metals. Yeah, so precious metals, gold and silver continuing to move up on the week. And we've also know their year-on-year change. Platinum pretty much unchanged. Rhodium down 2%. Rhodium is hugely volatile, and palladium, interestingly, down 1.4%. Although palladium supply is severely impacted by potentially by what's going on with Ukraine, but car manufacturing is dropping, and Renault, for example, is closing its manufacturing in Russia down. So that may be a reflection of imputed future demand. There's gold. Flows into Bitcoin. And you can see that flows into Bitcoin plateaued a year ago. Flows into gold has been declining, but are now starting to pick up, interestingly. Silver, still within its trading range. Platinum, not doing a great deal. Rhodium and palladium.
Thank you, Richard. On to rates. So generally rising yields during the week as the Fed came out with a bullish statement saying that essentially it was going to raise short-term interest rates quite aggressively, leading to fall in bond prices across the curve in the UK. And there were also falls in the bond prices of the periphery in Europe. But in absolute terms, none of these numbers are remotely concerning. To put these in context, the UK 30-year is currently at 1.84%, CPI is at 6.2%, RPI at 8.2%. You'd think that bond yields potentially have a long way further to rise. But rising interest rates need not necessarily mean a hard landing. This chart was referenced by the Fed, and it shows that actually in the 1960s, early 80s, and 1994, the Fed did manage to raise rates without causing a recession, and it's saying it can do so again. There weren't strongly rising oil prices in any of those periods.
Yeah.
And the bond market essentially has shrugged off the invasion. So there has been no flight to safety. Bond yields have actually risen sharply over the period. But if you'd invested in bonds, you would have suffered the worst drawdown actually ever. And that is something we have talked about relentlessly since we started this podcast. And concerning is this chart. Everywhere we are seeing a deterioration in liquidity. So higher number equals worse liquidity. So this is my concern about both the equity market and the bond market. The bond market, US Treasury market, is meant to be the most liquid market in the world. And I'm concerned that if we do see a big sell-off, you'll find it difficult to get out. And therefore, I think you should be looking to get out before the market turns. And this is the peak of bond market stupidity, the Austrian 100-year bond, and its price has now halved in 15 months.
But it doesn't matter, Keith, because you hold it for another 98 and a half years, you'll get your money back.
You'll get nominally your money back. Whether, what it'll be worth in real terms is a very open to question. And this is the seasonality chart. And amazingly, it seems to be working despite the war in Ukraine. So, according to this, it's a run up to May. And then you might want to consider getting out. Richard, what are you up to this week?
Thank you, Keith. So my performance, I was up 1.1% in the week, 5.8% for the year, and a relative performance of 7.1%, basically no purchases, no sales. So my uranium shares did reasonably well. My Bitcoin did reasonably well. My gold and silver did reasonably well, and as did my oil. So it was generally a comfortable week, which causes me some personal discomfort because there's so much suffering going on in Ukraine, and there's sort of cognitive dissonance, isn't there, between that and this?
Yeah.
Not that one can do a great deal about it.
Well, donate some money to the Red Cross, the DEC, Richard.
Yeah, I think that's absolutely right, Keith. So the only chart I wanted to put up today was Cameco, a uranium miner, and it has just broken out of the range it's been in for the last 4 or 5 months. And there's more and more talk, more and more countries investing more and more in nuclear power. It is an inevitability, I think. I think the scales have fallen from the eyes of many global leaders who previously had this sort of Panglossian view that fossil fuels, and although they didn't really like them, ESG was all going to work out beautifully somehow. And clearly that's not true. The other thing I would say is that the detractors of nuclear power have a point, undoubtedly, but nuclear energy technology has advanced very significantly over the last 40 years. Most nuclear power stations in the West were built around about 40 years ago, and the technology is much more advanced now than it was then. So that was one other comment. So I picked this up as a letter from the FT about 10 days ago. Basically, it's a small graphite producing mine in Wales, and it produces natural flake graphite, which is required in lithium-ion batteries, amongst other things. But the UK Green Party wants to close the mine because it's a coal mine. And what this does is, to me, it emphasizes the inability of pressure groups to differentiate between the nuances of what they want and what they're trying to achieve, and the sort of blanket expression of antipathy against whatever their pressure point is. And that, I think, is a problem when it comes to having a sensible political discussion about issues that are important to us.
Yeah.
I shall leave it at that. Keith, how was your week?
Thank you, Richard. Well, I had a very good week.
Wow.
I was up 5.6% on the week as oil bounced. And that takes me up to 14.5% on the year. And I am substantially beating the all share. Now,
impressive.
I have only one trick, but I think I'm quite good at playing that one trick.
Yeah, yes, you are, Keith. No doubt about it.
So I actually continued to sell down essentially anything that's not oil and gas. And I just think energy will cause huge disruptions and losses to any company outside the sector. So Tegmar is a turnaround situation, and sadly, I don't think it's going to have enough time to properly turn around before the next recession. In addition, what it essentially does is sell plastics to the offshore wind sector, and plastics are hydrocarbons. Their input costs are going to be rising. Rambler had a bounce last week and I sold it. I still like Rambler medium term, but it's an underground mine, uses a lot of energy. And I just think that the world economy is on borrowed time, and I've sold all my companies which aren't oil and gas. And, frankly, when I decide to do that, I'm ruthless, and I will be aiming to buy back into Rambler during the next cycle. Now, what did I buy? I continued actually to switch into oil and gas. Now, these were quite small purchases, and I'm now about 20% cash, and frankly, I've stopped buying. But one thing I did buy was Petrofac, which had results which weren't great, but everyone is now investing in offshore, and Petrofac has been allowed to start bidding again for contracts in the UAE. And this week, the UAE announced that it was going to accelerate its investment to try and get to 5 million barrels a day. So is that going to mean new business for Petrofac? But primarily, the results are backward looking, and the oil market is improving, and I'm interested in forward looking. Okay, now where we are, to be clear, I think the oil price is going to keep on rising until we get demand destruction. And at that point, you want to get out. So it is now a question of timing the exit. And I am reminded of this great quote from my favorite investment book, Reminiscences of a Stock Operator, which I recommend to absolutely everyone. And I'm going to read this out. After spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It was never my thinking that made me big money. It was my sitting. Got that? My sitting tight. It is no trick at all to be right on the market. You always find lots of early bulls in bull markets and lots of early bears in bear markets. I've known many men who were right at exactly the right time, began buying or selling stocks when prices were at the very level which should show the greatest profit. And their experience invariably matched mine. That is, they made no real money out of it. Men who can be both right and sit tight are uncommon. I found it one of the hardest things to learn. But it is only after a stock operator has firmly grasped this that he can make big money. It is literally true that millions come easier to a trader after he knows how to trade than hundreds did in the days of his ignorance. So, to be clear, I think we are timing the exit from this trade, but sitting tight is now the core skill. And I expect the oil price to keep rising until it kills the world economy. Okay, let's go through a few companies.
And can I just comment? That is a fantastic quote. I completely agree with you, Keith. It's seminal to being successful. I'd also say that I don't think demand destruction is going to occur that quickly. I think that it will take quite a long time, even with significant price increases, and that, for me, suggests that this trade has some time yet to run.
Oh, good. Music to my ears, Richard. Let's hope you're right. Okay, a few weeks ago now, we talked about how i3 Energy had farmed out the Serenity field for a song. And I mentioned Orcadian Energy in that context, saying that it showed that the farm out market in the North Sea was weak, and therefore I worried about Orcadian, which has heavy oil fields in the North Sea, and whether it would be able to farm out. Now, at the time, I had a message from the CEO, Steve Brown, pointing out that the i3 farm out was for an appraisal well, whereas Orcadian know they've got the oil. So they have proven assets and they are farming out known oil reserves, and that should be much easier. So just to pass that on, we obviously wish Steve all the best, and once they're farmed out, I'll consider investing, but not until then. Now, this is an old favorite, Harbour Energy, and just shows how quickly the shares can move when the market changes its mind. I mean, we've talked about this throughout the past year, how it's basically the oil price has been going through the roof and Harbour Energy's been doing absolutely nothing. Well, bang. In the course of a week and a half, it's gone up 25%. And, hold on. Who knows how high this can go? And another small UK oil company that I have position in, Enquest Energy, had its results this week, and the share price has shot up, very heavily indebted, but is now got the money to start investing in activity. So it's planning 9 wells, 7 workovers, and 2 new wells. The first new wells in 2 years. So that's looking good. Jadestone Energy, I did a share talk on earlier in the week. Please check that out. That's a nice looking chart. And the company I will next be covering for Share Talk is the mid-cap UK listed oil company PetroTal with assets in Peru. And I've started looking at it. This is going to be interesting. Lots of disruption from the natives. Lots of geopolitical risk, I'm afraid. And that's it. So, thank you all for watching to the end. Please, can you press like and subscribe to the channel? And in the meantime, it is goodbye from Richard Weiser.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website.
including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.